September 15, 1992. Just after 7 p.m. in London, a Hungarian-born trader named George Soros has spent the day quietly borrowing British pounds and dumping them onto the market. By the time the Bank of England realizes what's happening, it's already too late. Within 24 hours, they'll burn through billions trying to defend their own currency and lose. One man walks away with roughly $1 billion. An entire country's central bank walks away humiliated. There's a term economists use for the exact trap Britain walked into that night. Once you understand it, you'll never look at a stable exchange rate the same way again. And we're going to need it later. Because the same trap is closing on a country you've definitely heard of, right now, in 2026. But to get there, you first have to understand what a currency's price actually is. Because on the surface, exchange rates look simple. One currency is worth a certain amount of another, the number moves a little each day, and somewhere in the background, serious people in suits keep it all orderly. That picture is almost entirely wrong. What actually decides the price of a currency is messier, more political, and far more fragile than the tidy number on your banking app suggests. Start with the size of the thing. The global foreign exchange market trades somewhere around $7.5 trillion a day. That's larger than the entire annual economic output of most countries on Earth, changing hands every 24 hours. The New York Stock Exchange, by comparison, handles a few $100 billion in a good session. Foreign exchange isn't a market, it's an ocean, and the stock market is a swimming pool next to it. Here's the first thing insiders know that outsiders usually don't. There is no single exchange rate. Every time you see the euro is at $1.08, that number is an average of thousands of quotes happening simultaneously across a decentralized network of banks, brokers, and electronic platforms. There's no central exchange for currency the way there is for stocks. It's what traders call an over-the-counter market, meaning every trade is a private deal between two parties, negotiated on a screen, cleared through a web of correspondent banks. The price you see is really just the most recent transaction someone was willing to report. The rate isn't set, it's discovered, one trade at a time, by whoever is buying and selling loudest at that moment. So let's break down what actually goes into that discovery, because it's not one force, it's a stack of them, and each one matters more than the last. At the base layer, you have trade flows. If Germany sells 100 billion euros worth of cars to the United States, at some point somebody has to convert those dollars into euros to pay German workers. That creates real demand for euros. Multiply that across every export and import on the planet, and you get a slow, steady undercurrent. Trade in goods is roughly 2% of daily currency flow. 2%, that's the boring 2%. Here's the part that actually moves your money. The second layer is interest rates, and this is where it starts to feel like a casino. When a central bank raises its interest rate, holding that currency suddenly pays better. So global money, pension funds, sovereign wealth funds, hedge funds, shifts toward it. In 2022, when the US Federal Reserve started raising rates faster than Europe or Japan, the dollar surged to a 20-year high against a basket of other currencies. Japanese yen holders got crushed, not because Japan's economy collapsed, but because parking money in dollars simply paid more. The rate you see at the airport kiosk is downstream of decisions made in windowless rooms in Washington and Frankfurt. That's still not the scary part. The third layer is capital flows into assets. When foreigners want to buy American stocks, American bonds, and American real estate, they need dollars first. So a hot US stock market pulls in dollar demand from around the world. The reverse works too. When investors got nervous about European banks in 2011, they yanked money out, sold euros, and the currency dropped almost 20% against the dollar in a matter of months. That's not commerce. That's fear, priced in real time. And here's where it stops being math and starts being psychology. The fourth layer, and this one surprises people, is expectation itself. Currency traders aren't really trading today's economy. They're trading their guess about tomorrow's economy versus everyone else's guess. If the market collectively decides that Brazil's central bank is about to cut rates, the Brazilian real starts falling before a single rate is actually cut. The move happens on the belief, not the event. Exchange rates are, in a very real sense, a live poll of what a few thousand professional traders think is coming next. And polls can be wrong. Spectacularly wrong. Hold on to that thought, because later we're going to watch that exact mechanism take the pound down 6% in 2 minutes, while every human trader involved was asleep. Now flip the whole thing over and look at what it costs to keep this machinery running. Because the picture from underneath is uglier than the one from above. Every country wants a stable currency. Wild swings kill exporters, spook investors, and make it impossible for ordinary businesses to plan. So central banks spend enormous resources trying to smooth the ride. The clearest example of what that actually costs is Switzerland. For years, the Swiss National Bank held the franc down against the euro by printing francs and buying euros, over and over, at massive scale, until it was sitting on a balance sheet of foreign assets larger than Switzerland's entire annual GDP. Read that again. A central bank in a country of 9 million people ended up holding foreign assets worth more than everything Switzerland produces in a year, just to keep its own currency from getting too strong. China and Japan sit on trillions more in reserves for the same basic reason: insurance against a market that might turn on them. That money isn't earning much sitting there. It's the quiet, grinding cost of pretending a currency's price is more solid than it is. And that's where the whole system has one structural weak point. Economists call it the impossible trinity. A country cannot, at the same time, have a fixed exchange rate, free movement of money across its borders, and an independent monetary policy. Pick two. You can't have all three. Try anyway. Hold a fixed rate while money is free to flee, and interest rates are set by domestic politics. And eventually the market notices. It smells like a contradiction. It bets against you. And once it starts betting, the cost of defending your rate grows faster than any reserve pile can absorb. This is why fixed exchange rate systems keep collapsing throughout modern history. Not because the governments were stupid, because the math underneath them was impossible. When the peg breaks, it doesn't drift, it shatters. Overnight moves of 10, 20, 30%. Import prices explode. Companies with foreign debt go bankrupt in a single morning. Ordinary people wake up poorer than they went to sleep. It cascades because everyone who was pretending the rate was real suddenly has to reprice everything at once. Watch it happen. Britain, in 1992, was part of something called the European Exchange Rate Mechanism, a semi-fixed system meant to keep European currencies moving in a tight band before the eventual launch of the euro. The pound had been pegged at a rate against the German mark that most serious economists thought was too high. British industry was struggling. British interest rates were being held artificially high just to defend the peg, and the British government kept insisting, publicly, that the rate was sacred and would not move. Soros looked at that setup and saw the impossible trinity staring back at him. Britain wanted a fixed rate, open capital flows, and interest rates that served its domestic economy. It couldn't have all three, and he calculated that the government would eventually blink. So he borrowed roughly £10 billion and sold them short, betting the price would collapse. Other hedge funds saw what he was doing and piled in behind him. The turning point came on September 16, 1992, the day the British press would later call Black Wednesday. The Bank of England raised interest rates from 10% to 12% in the morning, trying to make holding pounds more attractive. The market barely flinched. By early afternoon, they announced another hike to 15%, a genuinely desperate move, the kind of number that would strangle the domestic economy. Still, the selling didn't stop. By 7 p.m., the British Chancellor announced the pound was leaving the exchange rate mechanism. The peg was dead. The currency fell about 15% over the following weeks. Soros made roughly $1 billion. The British Treasury lost an estimated £3.5 billion trying to defend a price the market had already decided was wrong. Not a story about one clever trader. A story about what happens when a government tries to legislate a number that the underlying reality no longer supports. Zoom out to today, and the force reshaping this entire space is something the traders of 1992 could barely have imagined. It's algorithms. Roughly 70% of currency trading volume is now handled by automated systems, some of them executing orders in millionths of a second. The biggest banks, JP Morgan, Citi, Deutsche Bank, UBS, run enormous electronic trading platforms where humans set the strategy and machines do the actual buying and selling. This has made spreads tighter, meaning ordinary people pay less to convert money. It's also made the market faster, weirder, and occasionally violent. Remember the poll that can be wrong? Here's what that looks like at machine speed. In October 2016, the British pound dropped about 6% against the dollar in 2 minutes, in the middle of the night, for reasons that still aren't fully understood. Best guess, an algorithm reacted to a headline, other algorithms reacted to that algorithm, and a cascade ran through a thin market before any human noticed. The price snapped back within an hour. But for 2 minutes, the pound was priced at a level that reflected nothing about Britain except the reflexes of a few pieces of software talking to each other. If you want to see what happens when the impossible trinity finally wins, you don't need a hypothetical. You need Sri Lanka. Going into 2022, Sri Lanka was running a trade deficit, had borrowed heavily in dollars because dollar loans were cheaper, and let inflation creep past 10%. Foreign investors who used to lend to the country at 5 or 6% started demanding 15, then 20, just to hold its bonds. The currency started sliding, and every drop made its dollar debt more expensive to service, which forced more borrowing, which spooked more investors, which dropped the currency further. Within months, Sri Lanka's currency had lost nearly half its value. The country ran out of foreign currency to buy fuel, and people were lining up for hours at gas stations that had nothing to sell them. Turkey has lived a version of this cycle. Argentina has lived it more than once. The difference between a currency that drifts calmly and one that implodes isn't really about how hard a country works or how virtuous its policies are. It's a handful of ratios: reserves versus short-term debt, exports versus imports, inflation versus the rest of the world, sitting on the right side of the line instead of the wrong one. Which raises an obvious question. If currencies are this exposed to the whims of a handful of traders and algorithms, why do the biggest players in the world stay so deeply involved? Why does the United States tolerate a system where the dollar's strength can hollow out its own manufacturers? Why does China spend trillions managing a currency it could theoretically let float free? Because exchange rates aren't really about trade anymore. They're about control. The country whose currency the world uses to price oil, to settle international debts, to hold as reserves, that country gets an extraordinary set of privileges. It can borrow more cheaply. It can impose financial sanctions that actually bite. It gets a real-time window into global money flows through the banks that clear its currency. The United States isn't defending the dollar out of pride. It's defending an instrument of geopolitical power. And China isn't managing the yuan because it enjoys the paperwork. It's patiently building an alternative, expanding yuan-denominated trade with Russia, Brazil, and the Gulf states, one deal at a time. In fact, China is running its own version of the impossible trinity right now. It just hasn't hit the wall Britain hit in 1992, because it's playing the long game instead of defending a public number overnight. Which brings us back to that evening in London, September 15, 1992. A trader at a desk, quietly borrowing a currency he intends to destroy. A government insisting, publicly, that the number on the screen is real. A market that already knows better. From the outside, it looked like a bet on a currency. From the inside, it was a bet on a lie. The lie that any government can hold a price against the collective judgment of everyone willing to trade against it. Every exchange rate you see, on your phone, at the airport, on the news ticker, is the current answer to that same question. Not what the number is, who gets to decide the number, and for how long.